Good morning. Welcome to another Mindset Meets Mechanics session. And today, alternating with the What's Up with the Market status update, we do a portfolio considerations, real world portfolios webinar where we look at the real money live traded portfolios, see how they're going, see what else what we can glean from it, obviously measure, monitor, and then manage as well. So we're going to talk a bit about the managing bit today as a result of the monitoring and measuring, and that is doing a little bit of research, which is item number 3 on the agenda today. So it's it is an announcement that we're going to do with a change to the public portfolios. And when we get to that section, I'm going to invite Dave to come in and talk a bit about it, because he's been working on this with Carl and myself on the sidelines. So I'll let him do the talking. Right, before we get into all that, need to tell you everything we cover here today is general investment advice and not personal or direct investment advice. Okay, just a little bit about trading objectives, just to keep putting this into perspective. As I've said in previous sessions that we've had, this is the third one we've had of this portfolio consideration series, is all the time in the back of my mind, I'm thinking, why am I doing this? What is the purpose of being an active investor, of being a trader, in instance of SPA3 investor, a long-term trader? And that is risk number 1. Keep on thinking about risk number 1. Am I getting a good enough returns on my investable capital to get me through the rest of my life when I'm not earning an income, and to really have it sufficient in that nest egg to handle all the risks of retirement and get through and have enough to get by. So, and it's also to keep score. This keeps you engaged. It keeps you keeping score. Those people that hand over responsibility and accountability to third parties, the more you do that, the degree to which you do that is the degree to which you don't keep score and don't really have an idea of what's going on with your investments. And yes, I know friends who talk to me about this, and even family who have a look once, maybe twice a year when they look at their statements, but still don't know how that fits into what they need because they haven't worked it out. So it just keeps you tuned into a really important aspect and part of our lives, and that is, do I have enough? Will I have enough? And how do I, risk number 2, avoid risk number 2, or the majority of a risk number 2, and that is a large, huge correction in the financial markets. And a lot of people say, well, I don't have much exposure to the stock market. I have all my my investable capital spread across different asset classes, and that's great in theory until you have a 2008 when all asset classes correlate to 1. That is, they all go in the same direction. And so how do you handle that situation? Well, you got to have some kind of way of going to cash, and for a big chunk of your investable capital, and that is, we call risk number 2 sequence of returns risk. And that if that happens at the wrong time in your life, it has a massive effect on your lifestyle and everything that you can do. So those keep on ticking over in the back of my head as a recursive loop, and it's my main motivation and driving force, as I know it is for a lot of you who are watching the session and will watch the recording. So just keep reminding ourselves as to why we do this and why we need to get better at it as well. Okay, and this is the big picture recursive loop, and I keep focusing on the most recent part of a secular bear market, and this is really what we need to focus on. We need to have a risk management first, and then returns second focus, and it's that period that we're setting up for. Now, those of you who've watched my recent secular bull market update will know that where we are in this secular bull market relative to the others, et cetera, definitely not going to do that now, but at some stage in the next sort of 1 to maybe 7 or 8 years, this is going to happen again, and we're going to be in this long sideways movement, big swing, 50% fall type environment. And that's what we need to set up for. We need to have put in a regime, habits, processes to be able to handle that in an unflappable way. And so we want to be out for most of those periods and in for most of the rising periods, out for most of the down and in for most. And that way we can actually outperform a market that effectively just goes sideways for anything from 13 to 20 years. So let's get into the real world portfolios, having set that up again, and I'll keep reminding us. I think it's one of the things that we need to do and take responsibility for, to keep reminding you as to why you're doing this and where you are on that journey of getting better at doing that and setting yourself up for when that secular bear market comes. Right, going to look at these real world portfolios, and I'll focus on these three because they are real money. And there is a trader portfolio that Shane runs and publishes as well that you can download, and where that is as well. But that's obviously more active, but it's not real money. These are real money portfolios. And the objectives of these are of showing you these is to really have a warts and all real world conditions, and to do what, as a business, as a service as to what we provide for you, is to really bring you what we're going to bring you today as a little bit of a research update and a change based on what's been happening in the market and how our system, our process has been acting in the market. And so it's not just timing. I just need to remind you, it's mindset and money management. So it's the three of those. It's the timing, the mindsets, the psychology to be able to execute, and your position sizing. And of course, where does mindset come in? And as it does with everything that's practical in life, is we've got to get out of the nets, get off the driving range, and go into the middle and go into the golf course and score under pressure. And that's when in the pressure that we experience in the market is when we have money at stake, because that's when we make mistakes. Mistakes on the driving range or in the nets don't count. They do count in the real world, and that's what we have to do. We have to be able to execute under pressure in an unflappable, peaceful manner and get the profits that we want to. So we've got the portfolio performance. We've got 8 3/4 years now of real world execution from January 2016 to current. And just a reminder, we've made a couple of mistakes in the US portfolio. So I know most of you don't go back and look at historic sessions of these. At one stage, we ran a second US portfolio and we ran mutually exclusive positions. And then we kept that going, I think, for about 13, 14 months. And that definitely degraded the performance of the portfolio that I'm going to show you today. And we also made some minor money management. In one instance, it turned out to be quite a major money management. And it's a mistake in hindsight. But at the time, obviously, we executed as we should have and according to our plan. But we could have handled the reduction from 13 to 10 positions better, and we have updated that in the portfolio. Right, so what I'm going to do now is I'm going to hop into Beyond Charts in a moment. And but since the previous one of these sessions a month ago, going to do a portfolio update. We're going to look at 1, 3, 5, 7 and inception metrics just to get a feel for those or some of those, and we'll look at the equity curves as well to get an update on those. And right now, I'm going to quickly just give a little bit of a background on what's happened in recent market conditions since the month ago when we did this last session. So looking at the US first, when we did the session a month ago, this breakout hadn't occurred above this, and you can see that's a magenta line, which is just really demarcating this Fibonacci retracement. And we had a 23.6, that's a 38.2% retracement of this run up down to there, or just shy of it. And classic, a higher high, it's a higher, just a lower high there, higher low, and now a higher high, which hasn't yet completed. So we've had a breakout to new all-time highs. And from this period over here, which is, I think, the beginning of January 2022, the S&P 500 is up 22.06%. That's excluding dividends, and a 7.37% compounded per annum over 2 3/4 years. And we've had this was obviously not a very nice time to be in the market, where we had this downturn over here. Somebody did suggest that I should change the mouse. I haven't done that for that. We'll make sure we do that next time, just mindful of that. And we've had this run up since. So that's what's happened in the US in the last 2 to 3/4 years. In Australia, that 22% has only been just under a 7% run up, and that is to close of business yesterday on the Australian market, only a 2.41% compounded growth, and that also excludes dividends. But in interesting or good, amazingly, the Australian market has got above that all-time high from January 2022, and which was tested over there and a bit over there to get through, and then came down and tested support, and is now looks like it is in an uptrend and a breakout. So that's been market conditions. Notice all this while during the downturn, all ordinaries, ASX 200 outperformed the S&P 500, i.e. less volatile to the downside, but on the rise up has been underperforming the whole time, and that is where we can get better returns in the US market. Right, some recent sells since the last session, which is I think right about the 23rd or so of September. We've sold REA Group this is an ASX portfolio, for 20.68% net profit. And we sold Flustered. There was actually quite a long trade, 322 calendar days. That is almost a year. So not a very volatile rise up. And we've also had a loss trade in Flight Centre, pretty short trade, and then a 9% profit trade in Super Retail Group, which we held for 76 days. And there were dividends that came from both of those winning trades as well. So those net profits exclude dividends. There's just a really good profit, a really good, I think about $1,000 or more, $1,300 worth of dividends that we just got from Super Retail Group as well to add to that. So it would have doubled the overall profit if you take the dividends into consideration. In the US market, we've had 2 sells. One was Biogen, which was a stumble. I'm kind of registering stumbles, if you like, as more than a 10% loss in an individual trade. But we also had a profit trade in merely MELI, and the same in this is the third one over here is the leveraged US leveraged portfolio. So that's the ASX US, the ASX portfolio, US public portfolio, US leveraged portfolio, and slightly different here just because of the obviously we've got smaller position sizes in the leverage, percentages a little bit different because of brokerage. Right, recent stumbles, we haven't really had one in the ASX public portfolio, and 2 in the US or the same stock in the 2 US portfolios, Biogen, 12.4, 12.5% loss. Recent leaps in the ASX portfolio, this is an open trade, still in JB Hi-Fi, 25.3. REA is now closed, 20.7% profit trade. In the US, we've got AXP, American Express, still open, 79 points. These are all still open trades. FICO, in a relatively short period of time, 43.8%, and Lumina, 26.7%. In the US leveraged portfolio, 2 the same, but we've also got UAL, which has very quickly shot up to a 48% profit, and Apple sitting on 29.7%. Right, let's now I'm going to just go into beyond charts quickly, and we'll start looking at some of the portfolios. Right, I'll start off with the ASX portfolio, and had a pretty red day, and good opportunity to talk a little bit of mindset here. Is these days happen, and it's just totally red. I should just point out first that we've got 1 vacant position in this portfolio, looking for a new entry signal, and $13,000 of open trade profit. But we do have these red days. So there's 1, 2, 3 of the trades are net loss trades at the moment, and the rest are profit trades. And BlueScope was only opened on the 16th of October. The longest is JB Hi-Fi, been holding that since June. So we haven't got really long open positions here yet, and this reflects what's been happening in the market. On the long term, since inception equity curves, that is what the grey is the ASX portfolio, and you can see this kind of sideways moving for some time now. Which stay tuned for the next section when Dave joins me. We'll talk about the changes we're making as a result of that. and the research we've done recently. But just looking at more recent time over here, I'm just going to go to here, and we're just going to compare to look at what's happened over the last year. In fact, I'm not going to go through all the periods in this one because we're going to use up some of the time to talk about the announcement. So I'll just quickly go back and look and see what we are doing, what's happened over the last year, and compare that to the index. And this is an example of what you can do as well, and you can get an idea of how we're doing. So just over the last year, this portfolio is up 14 point. This is a rolling 12 months, 14.24, and underperforming the index. So we'll just leave it at that. Just do the 1 years in this one. The next time we'll do some more when we haven't got some announcement stuff to make. So let's just quickly go on to the US portfolio. This includes today's session in the US. So a bit of green there, but we are fully invested. We should show you that first. And also, how are we doing relative to the market? We are closing in at 1.4% compounded behind since inception, and over the last year, the market is 23.10, and just compare how the portfolio is done relative to the market. And the US market over the last year is up 40.15%, and this portfolio is up 36.33%. So slightly underperforming, and that's great returns. You have to be in the game to get it. Now, what else do we want to do? Just have a look at some equity curves. This portfolio made a new all-time high sometime around about here, which was March of this year. Bounced around and has risen up as well. So still slightly underperforming the US market, and that is despite the couple of mistakes I mentioned. So that's a good overall return on capital. If you want to see the whole again, that's 13.32% compounded per annum. Okay, let's just quickly go on to the leverage now. We've got we've got fully invested here, 15 vacant positions. We've got $20,000 of open trade profit here, and the portfolio value is $51,000. This is the open trades at the moment. Some goodies over here: 79, 26 Illumina, 43 FICO. These are the ones I'm showing you. So besides the ones that were in the leaps, there's UAL, only been open 39 days and already up 48%. There was one really big day in that. Okay, what else to show you here? Let's just go and look at the last year of this, 2210, 2023, and so we have to go just to statistics. So this leverage portfolio is up 143% over the last 12 months, compared to the index being up 40%, and that's what you can do with leverage. A bit more drawdown. We've had a 24% drawdown in that period due to leverage, compared to the market having an 8.45% drawdown. So that is the benefit of leverage, but you have to, this is what we are working on, is we don't want that to occur the next time that we have unfavorable market conditions. So this portfolio is up, let's just get the numbers a bit bigger, is up 307% from the 22nd of from the 26th of September 2022. In the same time, roughly, I've just taken equivalent troughs. There is the S&P 500 is up 64% in that time. So leverage does work. It's a bit more of a volatile ride, and that is just using SPA3 investor signals. Right, we are going to now move over to have a chat about what we're going to release in the coming week or so. So there's going to be a change to the AS public portfolio rules, and I'll just give you a little bit of background. In November 2022, we're talking about stock filters here. And in November 2022, after research that we did at the time, we decided to turn the stock filter on and leave it on in the public portfolio. Right, Dave is going to come in and join me. Welcome, Dave.
Hello, everyone.
Get across there a bit more. Gotta get into the picture.
Yep.
Some more.
Oh.
Okay, I think you're in.
Very cozy.
Right, and we turned the stock filter on, and we traded the public portfolio. We updated the investment plan with that, and then and following also that ongoing research, we also re-researched the parameter settings for SPA3 Investor, and that was to do with the ASX, with the ATR trailing stop, and we made some changes there and implemented those into the investment plan for the public portfolio from May 2023. And now in October this month, we've done some research, and what we are looking at is out of sample data, focusing on this period since we went live with those parameter settings. And anything to add to that, Dave, in terms of the background leading into what we've done?
I think the important thing to realise is that as, I suppose, custodians of the systems, etc., that we pay a lot of attention to public portfolios. We also pay a lot of attention to member feedback, and we also use the simulator, which I'd encourage lots of members to also get familiar with. And the reason we do that is to monitor systems in real time. So we've got a really acute awareness of what's going on, and I think that's really paid out over the last 18 months in particular, being able to make some observations about real money portfolios versus simulations, and to make some adjustments where we think it's justified.
Correct. So that's the monitor, measure, manage. So, and part of the manage is certainly you got to manage your portfolio, but that's the monitoring and the measuring as you're going, and then the managers to do some re-research from time to time, which you can do. The mechanical system, very difficult to do with a subjective system. So we've found some stuff. So just talking about that out of sample data, again, just putting that into context is, prior to putting on the stock filter and also prior to the parameter changes, we obviously did a lot of research, running multiple portfolios, doing individual parameter research over different kinds of price data going all the way back to the 1990s. And then we make a decision, put a stake in the ground based on what the data is telling us. And then we walk forward in live trading. And then a period of time goes by and you say, okay, now let's just do some more research. We noted, as Dave just said, we're noticing stuff, we're getting feedback, we're noticing it in our own real money portfolios. Let's now go and do some out of sample research. That is the new data that's been added since we made these decisions and put stakes in the ground. So we're going to flick up a couple of charts here, and I'll let Dave talk to those.
Yeah. So here at the moment, you'll see two equity curves, one with a stock filter off and one with the stock filter on. And now this has been, you can see on the bottom left-hand side of the screen there that we're going back over, over 12 months?
Beginning of 23?
Beginning of 23, yeah. So that was basically when we implemented the stock filter. Now, one of the things we need to keep in mind was, why did we initially add the stock filter? And we did a lot of research, and we got to keep in our minds the biggest challenge for most investors is that of dealing with drawdown. So the idea of having the stock filter was the research took us down the path of what is a method that we can apply to our process that might have a positive impact on the level of drawdown, i.e. help to reduce drawdown in, particularly in large bear markets. So obviously we did a whole lot of simulations and realised that applying a stock filter was actually a good thing in some of those really severe bear market sorts of conditions. So we made the decision at the time to go with that, because the biggest challenge for all our members is dealing with drawdown. So let's try and, tick that box and make it easier. Now, since then as well, one of the things that we've done as a company is to introduce more training on mindset to help members deal with drawdown. And that continues to grow and develop, and we're getting lots of great feedback from that. So with that as the background, the context, if you like, going through and having a look at relative performance of portfolios, in this case a 9-stock portfolio, which is what the public portfolio is, and going through and running some simulations since we've actually applied that stock filter gives us a bit of an insight into how that is actually working in the market. And the feedback, and obviously also from our own public portfolios, which we go through and update every week in the weekly wrap, it's become obvious to us over that particular point in time that the stock filter was having an impact on relative performance. So you can see here in this particular period, the green line, applying that stock filter over the last 1.5 odd years, or a little bit more than 1.5 years, has really led to a portfolio pretty much going sideways. And so in comparison, if we take that stock filter off, we can see that the simulation in this case has shown that we've got more growth. So the stock filter, by applying the stock filter, what it tends to do is it's getting us into trades a little bit later. And if the trends happen to weaken, then we don't end up with as much growth in the trade result as what we may have if we had got in at an earlier level. So again, keeping in the back of our mind that idea of potential drawdown and dealing with that, if we're well versed in, we've got better skill sets, etc., then we really shouldn't have any difficulty moving to a stock filter off situation. So I think here the benefit of having the stock filter off is that it's releasing the handbrake of that the stock filter on was having. So it's giving us more performance over that particular period of time. And we can also go back and have a look at some slightly longer time frames as well.
And just to comment on that, it's this ongoing tussle between risk and reward, isn't it, all the time? And I think with the years I spent researching systems, is that the more you apply to try and reduce drawdown, the more variables that you put in, the less degrees of freedom that you give a system to run, i.e. you stifle it a bit to try and reduce drawdown, the less growth you get, but you get lower drawdowns as well. So you can't have it both ways. You can't have low drawdown and high growth. To release the growth, to give the freedom to the system, the degrees, that's what they talk about, the degrees of freedom, to let it do its thing. It means that you're going to suffer deeper drawdowns. And I remember years ago attending a live webinar with Larry Williams, presentation before we had webinars. And that's what he basically said. He said, how much drawdown can you handle? Because that is the ultimate question that we all have to answer. And the degree to which you can is the degree to which you're going to get greater returns. Yeah. Just look at the leveraged portfolio. Yeah. Right. Moving on to a longer time frame.
Yeah, so this is the same window, if you like, as what the public portfolio has been running for. And you can see the difference between the two. Now, for the vast majority of it, they're fairly similar in terms of sort of relative performance, but it's more in recent times where we've had a period of perhaps a sideways market moving out now, sort of particularly in the Australian market, sort of really starting to break out into all new time highs, that of more recent times, having that stock filter on, again, we can see the handbrake that's been applied there. And again, we need to be mindful. If we've got at the end of the day, we've got a rules-based system which has exit signals. And that's really important because at the end of the day, following those exit signals and how well you're able to do that is going to have an impact on what actual real drawdown you experience in your own portfolio. So if you're good at following the system, etc., then by taking that stock filter off, it's going to open up the gateway to relative, more performance than having the stock filter on. So from that point of view, there's going to be some changes that we're going to be making to the public portfolio and investment plans, and so we'll be updating that, and we'll be taking the stock filter off. Now, from that point of view, in Beyond Charts, we're going to automatically in the background update the settings. So what that's going to mean, you won't need to do anything at all, is that we will automatically update your Beyond Charts profiles. So there'll be a new release, and don't worry, we'll let everybody know when the new release is coming, so you're all ready for it, and give you plenty of notification through messages on the forum, also via emails, and also an alert in the app that we'll send out as well to say, hey, please note we're turning this stock filter off. So from that point of view, you won't need to adjust anything, any settings, etc., within Beyond Charts. So that's all coming.
One thing to add to that, it's only going to be the default parameters. So if you've set up any of your own parameter settings, I know some of you really turned the stock filter off, then those aren't going to be touched. Yep. So, but if you don't use the default parameter settings, and you do a stock filter on in your own private ones, we won't be touching those. So the stock filter will stay on in those default parameters. So yeah, and the timing on this, next week sometime, we want to obviously move the public portfolio to this as soon as possible. We've just got a little bit more testing to do, and we also do, although they're not connected, there will be a new release of Beyond Charts coming out into beta probably mid to late next week. So and that's got other things going on in there as well. So there's going to be two things happening, and we'll be communicating with you through all the different means that we have to do that.
Yeah. So part of this research, we verbalized it, but we've also put together a white paper as well. Now that white paper will be embedded into Beyond Charts. So again, under the Home tab, there's a document section where all our investment plans, etc., are also housed. But there's a section that you'll be able to go down to and see the original white paper. So all the original research that we did a couple of years ago now, you'll be able to see all that information. So down there underneath the white papers there, you'll see the re-optimization May 23, third one down. That's all the original research that Gary did, spent a huge amount of time in that. So you'll be able to go through that and refer that to the original research, and then we'll add the more current research as an extra document that you'll be able to go in and read as well. And we'll point to that in the upcoming emails and notifications as well.
Right. I think we've covered it all. Are there any questions? We've been so clear that there are no questions, Dave. And there's a good number of people that have attended today.
Yeah.
So that's what's going to be happening next week. And in terms of the next Mindset Meets Mechanics session, I'll be doing an update in a couple of weeks' time. That'll, I think, be the Wednesday after Cup Day. And then we'll be back and do another one of these in a month's time. So if there are no questions, we'll finish there. Thank you for your time and attention. And as always, we wish you consistent, objective, and peaceful and unflappable active investing.